Hey, everybody, we'll talk about the after the Oscars in a moment, but I want to talk about in video version an organization and a facility that it turns out is impacted by the Silicon Valley Bank collapse, but it's not a tech startup, nor is it a tech mogul who's put their money into Silicon Valley Bank. It's SoFi Stadium. And giant Silicon Valley Bank's crash has not only harmed its tech startup clients, but also the home of the National Football League's Los Angeles Rams and Los Angeles Chargers, SoFi Stadium. And that's because the SoFi FinTech organization has a naming rights agreement with LA Stadium Entertainment District, the owner operator of SoFi Stadium, the home of the Chargers and the Rams. That that SoFi naming rights agreement is reportedly at $625 million to be paid annually over a 20-year period. How this matter of SoFi Stadium becoming involved in the Silicon Valley Bank collapse is because SoFi received something called a risk retention facility from Silicon Valley Bank in 2020, not too long ago. A press release I have in the text below, but I'll read it to you. It was issued November 19th of 2020, and it goes like this. The bank, Silicon Valley Bank, SVB, the bank of the world's most innovative companies and their investors, today announced that it has entered into a multi-million-dollar risk retention financing agreement with SoFi, the digital personnel finance company. This agreement provides financing to be used for SoFi's risk retention bonds as part of their asset backed securities issuance requirements. SVP truly understands the unique needs of innovative companies like SoFi, said Chris Lapointe, CFO of SoFi, as the asset backed securities issuance requirements market is an important source of debt financing for SoFi. This committed revolving door facility allows us to reduce risk at favorable terms. SBB's specialty finance group provides revolving lines of credit and term loans to companies and funds active in the consumer and enterprise sectors. The specialty finance team has deep, proven expertise providing custom credit solutions such as warehouse facilities. Quote, we're pleased to offer this tailored financing solution to SoFi and other fintech companies to enable greater flexibility as they focus on their core mission of helping individuals achieve financial independence, says Nick Christian, head of specialty finance at Silicon Valley Bank. SoFi is a leader in the personal finance space, and we are proud to expand our relationship with the team. So, what will SoFi do now? This is me talking. And to what extent are they harmed financially? SVB's demise damages SoFi's line of credit deal. So, a cold read of the situation points to the organization having to consider clawing back money it spends for marketing. Yeah, sports marketing. It would come as a shock if the SoFi naming rights agreement wasn't already up for consideration by the executives that may be meeting Monday as a casualty of the SVB death's impact on SoFi's finances. Stay tuned. And this bears repeating. This is a big problem because if you have organizations like SoFi Stadium that basically are saying this is the land of it. Hey, we need a place where we can get extra money, we can borrow it for whatever working capital needs we have. Working capital means, for example, the stadium needs to pay you or it needs to fix something, right? Well, guess what? If that's the case, or not the stadium, I'm sorry, SoFi itself, but if that's the case, then and they're scheduled to basically doll out $625 million over a 20-year period, then that's 625 million that they take away from their own needs to service their customers. But their cash flow and size were such that they didn't think that was going to be a problem. And then along came Jerome Powell, the Federal Reserve, jacking up interest rates at a time when the economy was already weak and triggering what led to a run, an incredibly large run on Silicon Valley Bank, done because the bank itself tried to sell off its loans, but they did so at a loss of 1.8 billion. They sold off 2.2 billion dollars worth of not loans, bonds, excuse me. They sold off 2.2 billion dollars, but they only got a 1.8. They lost to 1.8 billion. That's okay. That's scary. And so word spun around the venture capital community that your money may not be in the bank anymore. It might be gone. I mean, imagine that, okay? That's scary. You have a bank that supposedly isn't dealing in anything more than real dollars, convertible dollars, right? And you're confident they're there. Then you have the FDIC, so you think. So you're thinking that a buck you take out of your pocket is really a buck. It's going to stay there. But what's happened is that for a percentage of Silicon Valley Bank's customers, that bank looks like this. They might as well have taken it and done something like this. Here it is, okay? Like that. That's scary. And that could be your checking account or your savings account. If you've had bills due and that happens, you have mortgage due and that happens, you're scared right now. You're scared right now. So this should scare the heck out of people and alert them to the fact that we are not properly managing our economy. That we so forgot about economic planning, we have allowed key industries rely on every single day. Like, for example, the service industry for communications, we call them call centers, right? To go offshore. So if you pick up the phone for help with AT&T, who I'm with, more than likely you're calling the Philippines. There's everything wrong with that because you have people here who need a job that they can do at home, a call center job. The company's retort is it's too expensive here. Well, that's where the government can come in and fill the gap between what the people who work there need to live and the company can afford to pay in order to survive. That gap, all right? That's what needs to happen. So we have to eschew these ideas of the free market because all of these other nations, Japan, the Philippines, I'll put it very bluntly, and folks don't like it, the mono-ethnic nations, the ones where you can identify the Swedes or the Japanese or the Koreans, okay? They all take care of their own through business. What I mean by that is consortiums, government financing those consortiums to take advantage, give them an advantage in worldwide competition. That's not something we do on a common, constant, aligned, coherent basis. We need to start doing that. We need to redefine the meaning of real money. I'm not going to sit here and blast cryptocurrency, no. But I am saying then we need to repatriate the dollars that we have let leak out of our system in different ways. In particular, by getting companies back here, having them build here long term, but the short term is the government has to begin to subsidize businesses that lose money because of the pandemic, where you have governments telling restaurant owners to close their doors, but they're not paying the restaurant owners while they're closed. All right? I mean, what kind of sense does that make? None. And yet, that's what we did for several years. And then we didn't work to align the payments when they came up to a kind of, I call it soft landing, where the payments eventually go away, but only when we know the economy is healthy. You can't judge it by employment. Yeah, you quite literally have to go out, because employment statistics, I think, are fixed in a nasty way. You have to go out and actually survey the people in your area. All right. So we have to begin to change the way that we do things. And we have to do it toward an eye of getting money to people so that these worries and concerns are diminished dramatically. If we do that, guess what happens? The crime rate in the United States goes down. Yeah. Robberies, property crimes go down. That is a statistical fact. Okay. So more on this later. Subscribe to Zenny62 and bookmark oaklandnewsnowblog.com. That ends this broadcast. Oh, and by the way, that SoFi Stadium is impacted this way should cause every NFL fan to ask their team owners if they're looking at that company's naming rights situation and their ability to complete payments in all of this. Because if they have to stop those payments, this is how it impacts you. If they have to stop those payments, those companies stop those payments, millions of dollars that then go to help pay off a construction bond or loan in some cases, team working capital in others, depends. And regardless of the case, you may be asked to cough up more money to go to those games. Or guess what? The government is going to have to do something like we did back in 2007, 2000. Actually, even before that, we had the Reconstruction Finance Corporation. I think that's the kind of model we're going to have to go back to. You would say, what is that? The Reconstruction Finance Corporation was an organization set up to purchase land and do a vast distribution of, I would call it, wealth assistance during a time in the 80s, just after our recession. We were trying to get out of the recession. Because I contend that we would not have had the recession problem if Paul Volcker had not thrown a choke chain around the economy to do what? He did this in 79, as they say on the street today, call himself reducing inflation. What he basically did was he ensured that Ronald Reagan was going to be our next president. That's a fact. So he also ensured that we were going to have a recession that took us some time to get out of. All right. Ronald Reagan did unlock growth over that time, but people conveniently forget the fact that we did not have to throw a choke chain around the economy by going from an interest rate policy to a monetary policy and then causing interest rates to rise as they did. Sound familiar? Sound like what we're going through today? Yeah. The end result does not look good. And that's why I'm saying that Biden needs to fire the Fed chair. All right. All right. Again, I'll see you all later on this. Oscars talk next. That ends this broadcast.